All right, so I'm Jason Yarusi of Yarusi Holdings. Welcome back to this month's monthly update. Has been a tremendous amount happening out there for everyone here active into the multifamily market. So let's dive in. But of course, before we do that, make sure you go down there, hit that follow button, give us a comment, talk to us about other thoughts, your feedback on what's happening out in the market. We love your comments, love everything you do to us. And again, I'm Jason Yarusi of Yarusi Holdings, a multifamily investment firm here in Nashville, Tennessee. We want to talk again today about the monthly update. So it's been a very dynamic couple months here. As we've all known, we've been hearing so much. I think 90% of CEOs out there say that we are heading for a recession. We're seeing interest rates rise at a rate that we don't see in sight. There is a lot of talk that we're going to continue to see an update, an increase this month, which pretty much is a no-brainer. And again, next month. And then when will that stop? When will that continue to find some peace of mind for us out there into looking for active loans? So the consumer price index rose by a 2.2% year over year in September. Now, this was slightly above the consensus estimate of 8.1%. And even though we have seen a lot of relief when going out there to the gas station, it's been offset by the continued increase in housing, food, and medical costs. Core inflation, which excludes food and energy, most likely just really because of just the big swings in both of those, rose at 6.6%, and the Fed is on track to raise the federal funds rate again by 75 basis points this month, looking like we're going to see that at least that same increase going into December as well. We're maintaining momentum, right? So we do expect that we're going to see a recession coming in the first half of 2023. Has created a ton of volatility into the financial markets, and the lending environment has gotten real tight. A lot of lenders have either put themselves in a position where they've just put their pencils down and are not actively out there lending, or they've actually are coming up with term sheets that really are just not something that as buyers we can work with on our current assets to make sense of them. So my thoughts on this is that if you're going into projects and you're finding a great deal, that you want to be creative with your debt, because you want to be able to put on debt that gives you consistency and gives you stability in your operations. However, it gives you multiple flexibility that in 12, 24, 30 months, you have the option to roll out of that debt into another project or another debt option that would be better for the project. So again, what have been the impacts on multifamily? Housing, food, and medical costs continue to rise in September. It's really pair that with the increase of rents, even though they've trailed off, is still putting a ton of pain on prospective renters. And from that, housing costs were up 0.8% in September. Apartment vacancy is rising slowly. However, we haven't seen that major impact of the push up or the push up in prices really impact and really increase vacancy rates to this time. So as we look at this, there's been a lot of key takeaways. I was reading the investor sentiment report that Lightbox put out here. Here's the 6 key takeaways from the fall of 2022 investor sentiment report. Commercial real estate threats include rising interest rates, as we talked about, inflation, and supply chain disruptions. A lot of this is going to continue to come forward. We do need housing, but the cost to actually put that housing into the ground and the timeline to get that has become way out, that a lot of people have stepped away from building at this time because of the additional cost, the lag in timeline, and just how hard it is to actually get the supplies needed to do so. 90%, as we talked about earlier, express recession concerns. Emerging trends in industrial include multi-story buildings and robotics. So we're still, again, pushing away from the workforce, right? We have a lot of things that are starting to look into other sectors, right? So into industrial, that we're moving away from the workforce, trying to come in there and cut down our costs by replacing workers with robotics. Bearish outlook reported for the rest of 2022. No shocker there, and to continue forward into 2023. Office vacancies remain a concern, but tech firms are showing a lot of positive momentum with high amenity campuses around the country. So what's been driving office to continue to have some stability in this uncertain time is that the ones that are going out there creating a massively well-established feeling, the aura, the energy, the amenities plays, that's drawing in the tenant base compared to the ones that are just going out there offering the box and allowing the tenant to come in there and just say, okay, now you take it from here. And industrial demand is outpacing supply, and rent growth are expected to be over 20%. So, well, goes back to our supply chain, right? We're seeing a lot of plugs and plays into the supply chain here, where that's really driving up our prices still to date. Now, here are some things that we saw in the CBRE report. Investors tightened underwriting for prime multifamily assets more slowly in Q3. So going in cap rates, and we're mainly talking to Class A properties, going in cap rates rose 33 basis points to 4.09% in Q3 2022. It's slightly more modest increase than the 39 bips rise in Q2. Investors have reacted to heightened market volatility and higher borrowing costs by pushing up cap rates more than 72 basis points over the last 6 months. However, cap rates have risen from record lows in the Q1 of 2022 and are still slightly below the pre-pandemic, which was Q4 2019 level of 4.16. So as we see here, investors are still underwriting to annual rent growth of 3.6% over the next 3 years, and that's up from the forecast of 4.3% in Q1, but more than 3.1%. That's been the average from 2014 to 2019. So investors still see a lot of room for continued growth in rent. So as you talk about that, that's going to continue to push some of these valuations up in properties and may align where the resolution between buyers and sellers does not trail off, where we see these massive discounts come out as we continue to see rising rents. Exit caps have also increased more slowly, climbing 21 basis points in Q3 versus 30 basis points in Q2. Still, the 4.63 exit cap remains well below the pre-pandemic levels, and the internal IRR target rose by 35 basis points to 6.39. It's again surpassing the pre-pandemic average. And lastly, average asking rent barely budged during the quarter, rising by 2 cents to 4.45 per square foot. So as you look at this, we're seeing a lot of effect here on the lending environment. However, investors see a runway forward because as they see the downward pressure on where rents are dragging, where housing is, the need for housing will continue to see rising rents. Now, not the pace we saw before was sustainable, but a lot of these markets here continue to see these rising rents. And we're also seeing a large progression back to the cities where we saw a lot of people flee from during the pandemic here. So again, that is our monthly update. That is our October monthly update. Check back another month from now. We'll dive into the November monthly update. Like we said, we need housing. Housing is, of course, tougher to build right now. It costs more. Inflation is putting a strain on the cost to build. Also, supply constraints are hurting the timeline, and also labor hurting the timeline for getting these buildings built. That said, the debt markets are also pushing away from making a lot of these deals pencil out. So be patient, be consistent with your box, be patient and consistent with your underwriting. Allow properties to develop, to come to you. There's plenty of time here to make deals happen. You do not have to rush into a deal here. Find good partners, find good debt partners, find good investments that can carry forward for you and your future. I'm Jason Yarusi of Yarusi Holdings. This is the October monthly update here for multifamily. Thank you so much for joining in. Again, go down and hit that follow button if you like what you hear. Look forward to talking to you shortly.